Hello everyone, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and finance presenter and columnist for the ABC.
And hello everyone, I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And we are
the Money Café. Alan.
What's going on,
now,
Stephen?
Alan, I've just jumped out of the Xero hybrid AGM over there in Auckland, and it's all happening because David Thodey's the chair. $28 billion company, the accounting software outfit, the most successful thing New Zealand has ever produced. And they've just copped a 48% protest vote against their remuneration report. And they are a rare New Zealand company that actually put the remuneration report up for a vote. So vast majority don't bother.
They don't have to. They don't have to.
Correct. So I always go to their AGMs and say, you're a governance backwater, put up the REM report, and they all refuse except for Xero. So Xero does it voluntarily. And to David Thodey's credit, he's released the proxy votes early. So we found out an hour before the meeting that there was this massive 48% protest vote. So I've lobbed a couple of written questions about, which proxy advisors recommended, what are you going to do? And thanks for putting it up. But it is pretty amazing. Like they've got these this all-female leadership team who are literally getting, tens of millions of dollars. Sukhinder Singh Cassidy and the CFO Claire Bramley. So they're based in the US. They're on US-style pay packets, which are enormous.
Like what? What does she get? What does the CEO
get? She's aiming to finish up with owning 1% of the company if all of her options are granted. But the target remuneration is $23 million a year. The CFO got a $20 million Australian dollar sign-on bonus because she was leaving money on the table at her previous employer. So, look, they're just telephone book stuff. And they'll do the usual, we're recruiting in a US market and, you can't compare Australian apples with US oranges, all that sort of stuff. But the shareholders have spoken and it'll be interesting to see how they play it.
Who are the shareholders? Are they mainly Australian institutions?
Yeah. So it is primarily ASX listed. So their directors are all over the world. Their management team is primarily in the US. New Zealand is a tiny share of their revenue, but it is an ASX listed company, and therefore it should respect sort of ASX pay arrangements. But they, of course, say, we've got to attract, ex-Google, Amazon people like Sukhinder Singh Cassidy, the CEO. But they renegotiated her pay last November. She'd already been there for a couple of years, and then they just gave her a massive pay rise when she was already in the job, including a one-off options grant that was potentially worth another $26 million US. So anyway, look, it's well done for David Thodey for at least putting it up, and the shareholders are revolting.
So if they get another strike, they'll have to have a board spill. Is that right?
Well, no, this is the thing, though. The two strikes doesn't apply.
Oh, I see.
Because they're just doing it voluntarily. So they'll just, the only way you can take it further is to vote against the directors. And all the directors have been re-elected today, or three of them with more than 95% in favour. So they don't get that extra leverage of Australia's unique two strikes system that triggers a board spill after two strikes.
So it was a bit of a gesture by the shareholders, really.
Yeah, it's a harmless gesture, a non-binding indicative frown at these huge salaries. So yes.
Oh,
now
so you're gone.
I was going to say, now what have you been up to? I heard you for 45 minutes on the ABC yesterday talking about the economic roundtable with Phil Clark on the ABC's Nightlife program. It made me reflect, actually, Alan, that you were dealing with live talkback calls. It's a bit like a chairman at the AGM, whereas we get to see the questions in advance, think about them, choose the ones we want to answer. So well done on handling all those economic roundtable productivity callers for 45 minutes live on national radio this week.
I quite like doing that nightlife with Phil Clark. I find he's a terrific guy, and the questions are always interesting, and it keeps you on your toes. It's very good. I like it.
Yes. Now, what have you made of the roundtable so far?
Well, there's not much to make. I mean, we don't know really what's been going on inside it. Yeah, I think it's probably a good idea. I mean, I'm not quite sure what the aim of it is, because I just would have thought all the ideas for improving productivity and economic reform and so on are all well known. It's not as if they're going to come up with any ideas that Jim Chalmers and Treasury haven't thought of already. So I suppose what it is a matter of getting a consensus between the sort of people who matter in this country. And then you look at the invitees. There's 24 invitees, and there's 4 from the ACTU and 4 business groups, the Business Council, Chamber of Commerce, Industry Group, and Small Business Council. And so, in a way, it's kind of, in some ways, it's an argument between those two groups with a whole lot of referees.
And the only thing they can all agree on is fast-tracking projects, getting rid of red tape, dealing with approvals, which is sort of a pro-jobs, pro-development approach. But as soon as you get into tax, industrial relations, adoption of AI, a whole bunch of other stuff, you'll get the usual position-taking people in their corners and difficulty in getting consensus.
Yeah, well, I mean, this stuff about deregulating and getting rid of red tape, I mean, crikey, that's been going on for years. Everyone talks about that every election all the time, and it never happens. So, I mean, if they can come out of this round table with an actual plan to implement some sort of red tape removal, fine, that'd be great. But, I don't know. I mean, I've just been reading Aruna Sathanapalli's speech to the third day, which is embargoed till lunchtime today, so I suppose it's all right. She's the CEO of Grattan Institute, and she's done a speech about tax, in which she's saying we're taxing income tax too much, or individuals too much, and we need to move away from that. The Productivity Commission's report on that came up with an interesting thought, which was to have a 5% cash flow tax on companies and to reduce the company tax rate on profits to 20%. I'm not sure that's going to get up, but it might.
It's an interesting idea, though, isn't it?
Well, it is an interesting idea because, the problem is that people like Rupert Murdoch and that manage to find ways to get their tax down to virtually zero. Whereas a cash flow tax is harder to avoid. So, I think that's not a bad idea. The other idea I liked was ACTU's idea of 1.5% levy for training for large companies. I can't remember the size of the company. I think it's 500 million revenue or something. Anyway, they're saying that companies that don't spend money on training, equivalent to 1.5% of their payroll, are levied 1.5% of payroll. And it reminded me that when I started in journalism in 1970, the training was done by my employer, News Limited. I did a cadetship for 4 years, and the whole training was done, provided by News Limited. But now, if you want to be a journalist, you go to university and you get a journalism degree. And so, in a sense, the companies have outsourced their training to universities. And whereas we used to get university education for free under Whitlam, now you pay for it. So the students have to pay for it and put it on their HECS, and they've got to pay them the loan back. So what's happened, in fact, is that the employers have shifted the cost of training onto the staff themselves, which is which I think is terrible. I mean, the companies, these big companies and small companies, ought to be training their staff.
Actually, that's it. I've got an anecdote on that as well. I had the 3-year cadetship with News Corp as well. But I remember at one stage in the early 90s, they introduced a training levy of some sort, similar to this. And News Corp actually paid my HECS bill up front a couple of times during that cadetship because they could apply that against this training levy. So they were given an incentive by the government. And the result of that was they paid partly for my university HECS. So you're right. If you do, either spend it on your staff training them or levy them, it will get employers investing, maybe paying the HECS bills if they're a part-time student or paying for training. So it's not bad, but it's just it would be coming over the top in an already high tax country where our corporate tax rate is already 30% when the global average is 21%. So you can well understand the employer group saying, well, hang on a minute. You're just slugging us again. You need to cut the base to 25 or 20 or whatever. don't come again with another levy on top because we're already overtaxed.
Oh, well, of course they're saying that. They're all outraged, saying it's the worst idea they've had, an absolute crock of shit, they've said. I mean, honestly, they're carrying on like pork chops. But, all that's required is for them to actually train their staff and they won't have to pay it. So I reckon that's fine. That's my opinion anyway.
Yeah, anyway. So what do you think about a two-tier tax system? So the Productivity Commission is saying that only the top 500 companies that have revenues of more than $1 billion, they keep paying the 30% and everyone else comes down to 20%. Plus you add the 5% cash flow tax. So that would be a budget-neutral move, but slugging big business and helping small business. And because we have such a foreign-owned economy, because there are so many massive multinationals here, there actually is an argument for doing that if you want to help Australian citizens, because we are very much dominated by multinationals. Big. More than half, I reckon, of those $1 billion a year companies would be the global multinationals who dominate us. So, tax them a bit more. I don't mind the idea.
I totally disagree, Stephen. I think that the proposition that the small business is the engine of the economy is untrue. And Saul Eslake convincingly demonstrates that the engine of the economy is big business, not small business. And and Saul talks about the small business fetishization of small business, which I'm inclined to agree with. I mean, I don't think that we should tax small business less than big business.
Yeah, and we've already got state payroll taxes, which exempt small businesses significantly. So that kicks in, with different states at different levels. But it is primarily a big business state jobs tax. And, that's a terrible tax in my view. So, interesting that you think it's all... I mean, the other thing is if you had the two-tax system, you'd actually get a bunch of demergers as companies endeavoured to get below $1 billion in revenue and only pay 20% versus 30%. So there'd be gaming in the system, a bit like the way CSL is proposing a demerger of one of their vaccines business at the moment. So people would duck and weave to adjust to the system. But we should talk about CSL.
Well, I just want to say something else about the roundtable before we move on to CSL. I think the fundamental problem with the roundtable is that it's in the second term of the government, which means that they can't actually say there's a crisis, because if they did, they'd have to also confess to being responsible for it because they've been in power for 3.5 years. So the time to have sort of a reform roundtable is in the first few months of your first term. So you can say that we're in trouble and we need to reform and it's all the other mob's fault, which is what Hawke did, of course, in 1983 at an economic summit and said, we need to have reform. And that kicked off the whole reform agenda that led to 2 decades of higher productivity. But he was able to say it was all Fraser's fault. And the trouble is that these mob can't say that. And if you look at the issues papers that they've put out for each of the 3 days, the last page of them, they're not very long, they're only about 3 or 4 pages. The last page of each of them is a list of the things that the government's already doing on those 3 issues of resilience, productivity and tax. So the message from the issues papers for each of the days is that everything's under control. It's fine. There's just this lack of urgency and crisis, which Hawke and Keating managed to convey.
Yeah, but I actually think there's a little bit of a Hawke-Keating parallel. I think that Chalmers has ambition to become Prime Minister and has a far greater reform appetite. He's of the right, Albo's of the left. So I think Chalmers, this is a platform for Chalmers to put pressure on his conservative left-wing Prime Minister to actually take the economy and economic reform more seriously. And that's why you get the sense that Albo's a bit annoyed that there's been all this discussion about these issues which are not his sort of bread and butter stuff. So I think Chalmers... it's a win for Chalmers to get this discussion going, and then I think he'll be putting pressure on Albo to take a decent reform package to the next election, and that will also be effectively his pitch within the Labor Party as to why he can be the fresh new energy to take the government into a 3rd and 4th term. So I think watch Chalmers. I think he's ambitious. He wants reform. He's very capable, as we heard on the Money Café when he handled us for an hour with absolute aplomb. And I think he's the man to watch, and don't judge him too early and say this will be a do-nothing event, because he wants to do something with this.
I'll tell you what, Stephen, you don't often hear the words conservative and left wing next to each other. I thought that was good.
Okay, he's a big spending pro-union lefty, and he's got a more markets, business-focused treasurer who wants to rein in his big spending lefty and do some ambitious economic reform, which the unions would normally say, no, you can't do that. Just spend more money on our favourite groups.
I think you're right. I mean, he is conservative and left-wing. Yeah, I think that's true. It's very apt. I just found it an unusual thing to say. Anyway, on to CSL. What do you think? I mean, the stock was down 15% on Tuesday as people didn't like the profit outlook statement.
And a big job cuts and a panicked demerger of the vaccines business. I think there's a little bit of a theme coming through of like James Hardie, Breville, sort of Trump, tariffs, economic difficulties in the US, I think is a little bit of a theme. But what's stunned me is that they are now only the 5th biggest company on the market. They are down to 107 billion. They're almost behind Wesfarmers. Wesfarmers is now worth a record 105 billion. ANZ's at a record high. They are valued at 99.7 billion. So we're about to have a situation where all 4 of our big banks are worth over 100 billion. And CSL, which used to be number one, easily the number one, has fallen off the mantle and has had the biggest ever wipeout in one day of a listed company in Australia, because it's well over $10 billion. So look, shock horror. I mean, do the class action lawyers sue them for anyone who bought the stock leading into the shock downgrade? You don't normally see this with continuous disclosure, to have a top 10 company crash like that. And it's a big blot for Paul McNamee, who just only last week I was saying he's the greatest Australian businessman ever, long-term CEO for 23 years, been the chair the last 5. This is quite embarrassing for him.
Yeah, I know. Well, look, I don't know. I think its price earnings valuation is down to 23 times, which is below that of JB Hi-Fi, which is fascinating. But the other thing is that James Hardie fell 30% yesterday. So it was it wasn't as much in dollar terms, obviously, as CSL, but twice the percentage fall. So these are big numbers. Obviously, the market's getting a bit edgy, a bit flighty.
Yes. Well, it's priced to perfection, and anyone that's missing is getting absolutely smashed. So, look, today's actually the biggest day of the season. There's like 21 top 200 companies reporting. So we won't see it's 10 to 10 as we speak. So we're about to see a bunch of jerky share price responses to all of that, which you'll no doubt have on the news tonight. But it is a lot.
Mate, it's not my day today. I'm not.
You got the day off. Busiest day of the year. You got the day off.
Yeah, very good.
Yes. So, and there's so much stuff in the detail with these annual reports, all these results, because they also release the annual report at the same time if you're a June 30 company, and that includes the remuneration report. And I fell off my chair when I read yesterday that the chair of AGL, or the former chair, Patricia McKenzie, received a $730,000 settlement after getting injured on a site tour. And this blew their fee cap for directors. It's meant to be 2.7 million, and suddenly they've paid out 3.3 because the ex-chair's got a $700K settlement for an injury, and they're not covered by work cover, and the board's had to work up a director injury policy now. So
maybe directors should be covered by work cover.
Well, I think they should. They should. But the idea of the chair of the company lodging a claim or having a negotiation is, very unusual.
Do you know what happened to her?
No. Well, this is the point. They haven't said, whether it was sprained her ankle, broke her leg. They haven't said. But she's the former chair now. So I don't know if that was the issue as to why they switched chair. But
she's run away. Heavens.
Or perhaps hobbled away. So I think they do. I think they do need to say. because the medical expenses were $13,000 and the payout was $720 for loss and damage.
Oh, right. So it's not just for that's not just for.
Oh yeah, it's a settlement for permanent incapacity. I mean, directors can directors sue for stress? Can they sue for reputational damage? Can they sue for financial damage because their shares have gone down? Well, the answer to all of that is no, 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 and no. So it is interesting that you've had a legal settlement for an injury of the chair of the company. So
she must have really hurt herself.
It must be a very serious injury. So yeah. I don't wish to make light of it, but it is good that we get this disclosure, and it'll be an interesting one for the AGM coming up.
Just before we move on to questions, just want to note that it's Jackson Hole Week, which is the annual symposium held by the St. Louis Federal Reserve Bank in Jackson Hole, Wyoming. And all eyes will be on the Federal Reserve Chair, Jerome Powell, who will be making his last speech to Jackson Hole because his term finishes next May, unless Donald Trump sacks him first, which he probably won't do. I mean, look, the focus tends to usually be on, will they cut interest rates next month or not, which is on September the 17th, the Federal Reserve's next meeting. But there's more to it than that. I mean, and there's usually a lot of good speeches and presentations at this thing. So I'd suggest Googling Jackson Hole or St. Louis. Just go on the St. Louis Federal Reserve Bank website and check out the presentations. They're usually quite interesting.
And this means, Alan, that because the speech is Friday night, our time, which means you'll be burning the midnight oil, putting the finishing touches to your weekend briefing, which goes out to subscribers at 7 a.m. every Saturday morning. And I have to recommend it. It is the best read every weekend because the great man often gets up at 5 in the morning to make sure he's got the latest news for his 5,000-word wrap of all that's happening at 7 o'clock. So you'll be having a late night on Friday or an early morning, taking in all of Jackson Hole.
I always get up at 5 or actually 4:30 on Saturday morning to see, because I figure that the week that I don't get up at 4:30 is the week that the market's down 10%. And, I'll look like an idiot sending something out at 7 a.m. that doesn't include that. So, I don't think I've got any choice.
Yes. Well, you've been doing it for years.
I have.
So almost 20 years of that. So sign up, folks. It's worth. What's the cost of it? It's fantastic value. Best read of the weekend. So
I can't remember. It's always jumping around, but yes, you can't subscribe to that alone. You have to subscribe to Intelligent Investor.
Yes. Well, get on board, folks.
But it's a pretty good product anyway. So there you go. All right. Before we get to questions, let's have a quick word from our sponsor.
The market is shifting and the Intelligent Investor Australian Equity Income Fund is already ahead of the curve. While big super funds just recently started rotating out of banks and into resources, this fund made that move over 18 months ago. It's not waiting for the crowd, it's already positioned for what's next. The fund is built to generate income while still achieving capital growth, a great combination for long-term investors. You can invest now with zero brokerage fees directly through Intelligent Investor. But act fast, this offer ends Friday, August 22. Head to offer.intelligentinvestor.com.au/INIF to learn more about the fund and whether it's right for you.
Okay, first question from Luke. Thoroughly enjoy the podcast. My question arose as I pondered implementation of AI and intergenerational wealth. Paid work was essentially relied on an individual giving time in return for income. It's remarkably equal because time is something everyone has. How it is then spent or what we can do with that time defines the reward that an individual receives. That's very deep, that is. The seemingly greatest contribution envisaged by AI is a mass saving of time because of a huge increase in processing speed. Could we be moving to a new era where the commodity to be traded by individuals is less time-based and more individuals' income will be derived from a greater variety of sources, such as land ownership or other investments? I think it's probably not. I don't think the main thing is AI on this subject, but the main thing is the fact that we're moving from a demographic tailwind to a demographic headwind, which is to say that in the 50 years after the Second World War, the the working age population that paid income taxes was increasing much more quickly than the population of people who weren't working. But now that's flipped, and the working age population is not increasing, and the retiring age population is increasing rapidly because the baby boomers are retiring. And so we have got to the point where we need to shift our tax base from income tax to something else. And so, that's really the issue for today's roundtable discussion of what are we going to do about tax, because you can't keep focusing taxation on income tax when that headwind is that demographic headwind is going on. What do you think, Stephen?
No, look, I agree with that. But on the AI question, look, I agree with Luke that there will be massive time savings. And from a keep your job point of view, I think good advice is to be as multi-skilled as possible. So if you do get AI'd out of existence, that you've got, a variety of skills. You're not just one, a dedicated writer who's all of a sudden you've been taken out of your job. But yeah, I mean, a lot of people still get paid on the clock. A lot of people get paid more on output. But the richest people, the people that do the best, are those that are deploying capital, and their money is working for them when they're sleeping. So they're not on the clock, not measured by output. And I think that's where just the greatest challenge is the massive inequality. And if you don't start off, if you haven't got capital to start with, and your job's vulnerable from AI and everything's expensive, it is a time to be nervous. But look, I think you need to increasingly tax capital. And not labour. We're over-reliant on labour. And on AI, there is going to be massive efficiencies, and that's why a lot of people are talking about getting back to trades, because you can't be done over by AI if you're a plumber, a sparky, or a carpenter.
No, that's right. And also I think we might see the return of art and music and art people making decent money, because that can't be replaced by AI either, nor can sports. People who are good at sports will probably continue because that's another form of entertainment. I think AI won't be taking over tennis and footy anytime soon. So the football players on $1 million a year, they're safe, I reckon.
Yeah, it's funny. I was at an AGM yesterday in New Zealand, a company called Straker. And I'd lodged all these nasty questions because, the share price was at a record low, and I just assumed they were some, mining spruiker that had promised the world, and then it was all garbage, and then I listened to everything, and I really felt sorry for them. They were a language translation technology company. That used to be going great. So David Kirk's Bailador private equity fund bought them, built them, floated them at $1.50. They're now at 36 cents or something. And they're just getting smashed by AI. And they're desperately trying to pivot and bundle all their old products with new AI applications, but their revenue's down 10%. And I really felt sorry for them. This is a great business that is just on its knees, or the shares are at a record low. And I got smart aleck questions coming from across the ditch from someone who should have been more sympathetic, because a lot of people are getting disrupted. And this poor little company, Straker, for language translation, just pump it into AI and they'll do it for you. So
was that you being the smart aleck?
Yeah. And I felt bad because if you're up against it with AI and you've got some product you're getting disrupted, it's tough.
You should have gone easy on them.
Well, I did say, well done, good meeting, and thanks for taking all my questions and stuff. But, it just reminded me that a lot of people are getting disrupted. A lot of, even big businesses like Adobe and Salesforce, their shares are coming off because people are saying that the software companies are going to be the biggest victims of AI. So that's the biggest game at the moment, working out winners and losers and who can adapt. And the only certainty is that the infrastructure players, the data centers, the chip makers, the NVIDIAs, they're the guaranteed winners, and everyone else, we're still trying to work out what it all means. Now, Ron says, I'm hoping for an Alan Kohler explainer here on kangaroo bonds. Why are other countries issuing bonds in Australian dollars? Isn't that a risk if the exchange rate shifts? What advantage is there for using the Australian currency instead of their own currency? Who buys them? Is it mostly Australians, our super funds? And can any country just choose to issue bonds in any other country's currency?
The answer is yes, they can. to some extent, it's a part of the trend away from US dollars. The world is de-dollarizing to some extent because, well, it began with the Russian invasion of Ukraine in 2022 when America froze Russia's US dollar assets and US dollar holdings, and the rest of the world sat up straight and said, "Crikey, US dollar is not such a safe currency after all." And so there's been the kind of a process since then of shifting out of US dollars and issuing debt in other currencies. The other thing is that it's a bit of a bet on that currency. So if you buy Australian dollar bonds and the currency goes up, you win. So to some extent, kangaroo bonds are a bet on commodities because we're a commodity currency. So it's a way of, to some extent, a way of investing in China.
It's also a way of tapping into our $4 trillion of compulsory super. Quite a lot of our super funds they obviously do invest in, other US dollar denominated bonds and other fixed interests, but there is a preponderance of Aussie dollar, you don't take the currency risk. So people look at the 4 trillion here and say, let's come up with a product that some of those super funds would like to buy. Hey, let's try some kangaroo bonds. And so if you can get a lower interest rate, hedge your currency risk, then cost of capital, it makes sense. So I think that people are just chasing our super and chasing when our interest rates are low relative to the rest of the world. That's when you'd issue in kangaroo bonds. And that's a lot of Australian governments sometimes issue US dollar denominated bonds, or public companies do US private placements. So it's just a case of chasing the cheapest debt you can find. And we are a great stable economy and currency with a pile of capital with super, so people are increasingly looking to tap into that.
May is early 30s, young family professionals. Her and a partner have a mortgage, half of which is paid off and is sitting in an offset account. They quizzed AI research engine Perplexity about how we could increase our financial upside opportunities, and Perplexity said, debt recycling. Can you please elaborate on this concept further? What are the upsides and considerations for us? So debt recycling simply means using that money sitting in your offset to invest in something else. And so you might put it in the stock market or buy another house.
But it also involves, the implication is that you recycle into a tax-deductible debt.
Yeah, that's right. Yeah, that's right. It's got to be tax deductible. So that involves virtually anything, really. I mean,
yeah. But basically, what it's saying is, mortgage up your house, take some equity out, buy another property, and leverage the bejesus out of that. And then when you're paying off the two mortgages, your house mortgage and your investment property, keep the one that's tax deductible higher, so pay off your mortgage first. It's the same with leveraging up into shares. The only problem with people who encourage this is you are sending people up the risk curve, taking on more debt. Assets can fall in value too. But yeah, look, I was interested. The CBA result last week said the average amount of cash in their offset accounts of their customers was $83,000 across their, whatever it is, 700 billion home loan portfolio, which has literally no bad debts, not a dollar. They don't lose any money. But a lot of people do it. Because our tax rates are so high. Top rate kicks in 45%, 47% plus Medicare levy kicks in at 190,000. I mean, in the US, the top rate of 37% doesn't kick in until $1 million Australian dollars. So where people are getting absolutely flogged by our high income tax rates are often incentivized into tax-deductible debt investments with the margin loans on shares, negative geared property, and that's all that's really talking about with debt recycling. Mason says, the Tech Council of Australia has predicted 200,000 jobs to be created in the domestic economy by 2030 because of AI. However, forecasts on the displacement of lack of jobs in growth are more dire, with McKinsey saying 1.3 million or 9% of the workforce may need to transition occupation. Is there anything to suggest we'll see a lot of offshore jobs, for example, Telstra, Combank, be automated first? If so, maybe the net effect on domestic jobs would be in line with the Tech Council's forecast, or is the doom and gloom in the media more likely? Well, call centre jobs, Alan, are particularly vulnerable from AI, with the chatbots who can deal with a lot of the customer service inquiries, and quite a lot of Australian companies have offshored their call centre work, Telstra into the Philippines, a lot of into India. So, yeah, I think that that particular line of work, call centre work, talking to people on the phone, is it used to be 3% of all jobs. That number is coming down big time, and we have had some offshoring already. So to that effect, it will affect other economies more than us, perhaps.
My view is that nobody's got any idea what's going to happen, including the Tech Council of Australia and McKinsey and Company. I mean, we're all just going poking along. All we know that's going on is that the big seven tech companies, led by NVIDIA and Microsoft and Apple and Meta and all the rest of them, are going hell for leather. They're spending trillions of dollars on investing in this stuff. So whatever's going to happen will happen, and nobody's got any idea what that will be, I would say. I mean, everyone's got making predictions about this. We're going to you're just as likely to come up with a forecast that says half the world will become unemployed, which maybe that's true. I don't know. I mean, Tech Council of Australia is talking its book. It's trying to, say it's going to be okay. Not only will there be no job losses, we'll have 200,000 more jobs. Well, crikey, they've got no idea.
Well, big tech shares are up 30 to 50% since Trump's famous buy now claim on April 8, when he crashed the market with his crazy tariffs. So the bubble is still there, although the likes of Palantir actually fallen 20% in the last 6 days. But I remember I heard someone last week saying we're going to soon see the first unicorn company with less than 10 staff. And that will be a unicorn is a company worth $1 billion. And the 10 staff will just be wrangling various AI systems for whatever products and services they are delivering. So look out for that. The first $1 billion company with less than 10 staff, totally AI-driven, with a bunch of people at the top wrangling everything through various AI models and everything else outsourced and automated. That is going to happen.
Well, the other thing I'd say is that there's apparently thousands of driverless taxis whizzing around San Francisco, owned by Waymo, which is a subsidiary of Alphabet. And so if your living relies on driving cars or trucks or something, I reckon you're in trouble. These things in San Francisco are safer than humans. So.
Well, 7% of jobs in transport, driving jobs. I do agree. Driving jobs massively under threat with automation. So
yeah.
Your turn, boss.
Frank says, why do REITs specify net portfolio gain loss in the P&L? Isn't this unrealised profit and loss? It's then treated as taxable income and a key factor in performance. It seems to me they use net change in the whole portfolio, not net change of assets sold.
Look, it's an interesting one, Frank. You are right that the listed property trusts, Westfield, Goodman, Dexus, etc., they do have all of their properties valued every 6 months, and they do run it through the P&L. But because they're using sort of the managed trusts structure, they're not paying the 30% tax. So I went back and, for instance, I had a look at Scentre Group's 2018 profit. So it reported a profit of $2.34 billion. $1 billion of that was revaluations. Their properties had gone up, but they only paid $46 million in corporate tax. And that's because the property sector in particular, anyone with trusts, don't pay corporate tax particularly, but it's all paid by their investors. So they pay unfranked distributions, and then the model, much of which goes back to Frank Lowy's negotiations with Malcolm Fraser's then treasurer, a bloke called John Howard. That's when some of this early preferred tax arrangements for the property trusts sector was established, it is still quite tax preferred, and I think it's healthy that we get valuations of properties every 6 months, because you want investors to have confidence with what they're buying, and you don't want a situation where a company like Harvey Norman has got billions of dollars of property, doesn't value it, so you don't really know what it's worth. Whereas the big property trusts say this office building is worth $678 million. It's gone down $12 million in the last 6 months. It's a very transparent system.
Should they be counting it as a profit though?
Well, it's unrealised. So, in this whole unrealised tax debate, no one has come out and said that every time a property trust writes up their assets, they're being taxed, because they're not. So it's being reported as a profit. Maybe you could argue it shouldn't be reported as a profit, but it is being reported as a profit, but it's tax exempt if it's unrealised.
Yeah, right. There you go. Do you want to do the appalled about our CBA adulation?
Oh, Sandy Alan had the week off, and James Thompson and I were talking up the Commonwealth Bank too much last week, and Sandy reckons he was appalled by our adulation. And then he's just saying that Commonwealth Bank is ripping off customers, price gouging, poor service, and it's just a big, long, I'm not going to call it a left-wing anti-capitalism rant, but he's not happy that the Commonwealth Bank is worth $288 billion, and reckons that we were too soft on them. Now, Matt Comyn has been in the Productivity Summit for the last 3 days, Alan. I mean, I don't know. I think our banks are getting away with murder. I mean, for the first time ever, we've got 4 of them. If ANZ goes up another 0.5%, worth over $100 billion. And, they're getting close to being worth, it's well over $600 billion now. I think you can run an argument that they shouldn't be charging 21% on credit cards, but somehow they have avoided you're also rich, you're gouging us. How have they done that? How are the banks getting away with these record profits in a cost of living crisis, Alan? They're master strategists.
Because they are surfing the wave of unaffordable housing. I mean, the whole basis of their profits is the housing boom, which has been driving up the value of their loans. People just kind of in up to their necks in debt to these banks. I mean, the banks are making out like bandits because of what's going on with the housing market.
I think that Anna Bligh should get a very big bonus from the banking sector, because she has former Queensland Labor Premier, CEO of the Bankers Association, just retiring now. She has avoided a Labor-style pile-on against the banks for profiteering and making outrageous profits. And I was interested that Andrew Fraser, the former Queensland Labor Treasurer, was yesterday announced as the new chairman of the Bank of Queensland. And he's actually been at the Productivity Roundtable. He's also chairman of Australia Retirement Trust. So well done to the banking sector for capturing the Labor Party and profiteering magnificently without any government backlash whatsoever. Because they've got various Labor players in the tent. And I agree, their profits are over the top. But the regulators are letting them get away with it. So that's that.
So Anna Bligh turned out to be a good recruitment for the banks.
Although in a world of pain, Royal Commission was basically called because of Commonwealth Bank's terrible behaviour. And Matt Comyn was a good hire. He stabilised things. Anna Bligh stabilised things. They got through the Royal Commission. Remember when the day after the Royal Commission came out and the government said we're not going to introduce much of the recommendations, and the share prices went up by 20 billion on the day?
That's right.
They basically got away with it. Compare that to the casinos. I mean, the poor old casinos. Austrac's about to fine Star 400 million. Sky City this morning has announced an emergency $250 million capital raising at a 30% discount. They have copped a massive regulatory backlash for being found out to be money launderers and dodgy operators, whereas the banks, Royal Commission called all sorts of dodgy behaviour, get on with it, and record profits, and they're all now worth over 100 billion. The Commonwealth Bank's worth 289 billion, and the Labor Party does not seem to matter that consumers are paying for all of this. surely Sandy will like that. That was nice and negative on the Commonwealth Bank, was it?
I reckon that was right up Sandy's alley. He would have loved that.
I actually ran against Peter Costello in his seat in 2007, the seat of Higgins, arguing that he was too soft on the banks and that he should use his powers in the Banking Act to protect consumers. No one listened, and I got 2%.
2%. Well,
hopeless.
That's a triumph, Stephen.
Yes. Hopeless.
And Higgins, crikey. I mean, anyway, time for one more question, do you think?
Let's go for it.
Which one will we do? What do you
Lee says, just a quick whinge. I wish journalists would stop parroting the word generous in front of the capital gains tax discount references in all their opening statements. I've done the figures on my Melbourne apartment home for 10 years, and I'd pay less CGT on a sale now than if they used the old CPI measure. The narrative, of course, is to paint the picture that anyone who owns property they don't live in is aiding to the pain of the younger generation. Nothing to do with spending habits, of course. I have a young relative going to Fiji for schoolies. I went to Lake Hume in a caravan for my schoolies. So, Lee, what do you reckon? Is Lee right that we shouldn't keep calling the capital gains tax discounts generous?
Oh, well, look, it's true that if you hold the asset for a long time, then the CPI adjustments would add up to more than 50%. That is probably right. The average time of holding an asset, in particular an investment house, I think is more like 5 years, in which case the 50% on average, the 50% is more generous than the CPI. So 5 years of CPI sort of, well, especially what it is now, is much less than 50%. And I think that the Labor Party's proposal in 2016 and 2019 to reduce the discount to 25% was correct, given the amount of inflation that's going on these days. I mean, back when the 50% discount was introduced in 1999, inflation was pretty high. So the average time of 5 years of holding an asset probably was 50%. So it kind of was roughly the same. But now the 50% on the average time holding an asset is pretty generous. But if you hold it for a long time, so I suppose in a sense the 50% discount replacing the CPI measure is an encouragement to people to hang on to assets for a long time, which is good.
Yeah, but other things are generous too. We should call franking credit top-ups generous. We should call the super system very generous with its tax subsidies. The property trust sector is generously treated by the tax system. I mean, something had to change, Alan. I mean, poor old Malcolm Turnbull. I remember having him on the phone one time, and he got $60 million when he sold his stake in Aussie Mail to WorldCom. WorldCom paid $520 million in 1999, and he got $60 million. Do you know how much capital gains tax he paid on that? And he remembers he wrote the check, $22 million. So he received 60 and he copped a $22 million capital gains tax bill. That's punitive because our personal income tax rates are very, very high. So I do think that if you want to encourage investment, entrepreneurship, and be competitive with the world, you cannot apply Australia's punitive personal income tax rates on anyone who makes a successful investment in the business. And I go back to Malcolm Turnbull. That's a very big check, $22 million capital gains tax bill. He was very generous to the nation making that contribution, I would argue, Alan. And John Howard responded with a let's offer the 50% discount, and I think it was a good policy.
Yeah, I mean, look, the other thing I'd point out is that the income taxes are not adjusted for inflation, so we go up through the scales according to inflation increasing our salaries, and every now and again the government gives us a tax cut, handing back tax bracket creep, but bracket creep goes on, and now if the government doesn't hand back the money in a tax cut, everyone sort of gets slugged, and that's what's going to happen now. I think
and
that's
$190,000 for the top tax rate. I mean, the median full-time salary in Australia is $90,000. The average, including overtime, the average full-time salary is $102,000. The top tax rate's barely double that. So that they are the biggest victims, I would argue, is people who are bumping up towards that top tax rate, and that's why we got so many deductions in our system, because the rates are so nominally high. It would make a lot more sense to have a lower overall rate with less deductions, and that's what the rest of the world tends to have. But we just have this weird everything's driven by deductions because the headline rates are massively high by world standards.
Well, very good. Thanks, everyone, for listening to today's episode of Money Café. I'll be back next week with James Thompson. Send in your question and we'll answer it together. Email the question to themoneycafe@eurekareport.com.au. So until then, I'm Alan Kohler, founder of Eureka Report and finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor and teleinvestor, founder of Crikey, shareholder activist and keen reader of Alan's 7am weekend briefings. Look forward to this one's boss. Let's see what happens at Jackson Hole.
Yes, indeed.